Equity markets tumble with good news, and Bitcoin just keeps going lower. What does the macro world have in store for us over the next month? Let's talk about it. This and more on today's After Hours. Welcome, everyone, to After Hours at Traders Post for August 29th, 2025. I'm one of your hosts, Tom Hartman, marketing manager here at Traders Post, alongside my trusty sidekick, Peter Hartman, also part of the marketing team. Every week, we'll be going over some of the big macro themes that move markets in order to help prepare you and us for the trades for the week ahead. This week, it's been a crazy, volatile market week if you've been there on Price Action Live following Mike Christensen and I Tuesday to Friday as we trade. And it's been sideways, sideways, sideways all the way till today, where we fell dramatically when we didn't expect it into the Friday close.
You didn't expect
you would
it?
have thought, well, you would have thought that as it was happening, Mike and I were like, did like a meteor hit or something in Argentina that we didn't realize? Is there some news that's going on? No tweet, no nothing bad seems to be happening, and yet the market sold off pretty dramatically. Now, is it a 20% down? No. But for people who are used to markets going sideways or up, down is not the direction we want to see things, are they, Peter?
Well, I mean, that allows you to get in. That's good.
Yeah. I get that. I understand that. But it also means like, hey, I mean, if Donald Trump and the Jerome Powell are both trying to make markets go up, why are they going down? Which is what I want to cover today. All right, Peter, the macro world is replete with all kinds of different outlier events and all kinds of interesting things that can happen at any given time. Bond market auctions go haywire. You have policies that change dramatically and all that sort of thing. Today, none of that happened. Today, actually this week, we had GDP that was up 3.3%. That's 3.3%. I believe that's good year over year.
Wait, that's good. That's a good thing.
Well, yeah, I mean, it should be good. It should be good, except that, let me just confirm it over here. It was on Thursday. Yeah, 3.3% quarter over quarter. But previously, the previous quarter was down 0.5%. So somehow the economy performed even better than the 2% that you normally need in order to beat inflation, up 3.3%. Do I believe the numbers? Yes, of course I believe the numbers. I believe everything the government tells me. Today, we had inflation data come in. So the core PCE and PCE numbers. And wouldn't you know it, exactly according to expectations. Forecasted 2.9% PCE core inflation year over year, came in at 2.9%. Expected forecasted 0.3% PCE core month over month, came in at 0.3%. Expected 2.6% PCE price index. You can get where I'm going here. The numbers were dead on. Look, I don't care about whether I believe it or not. I care what the markets believe. And what we saw in equity markets is that we had a little bit of a bump up last night or this morning at 8:30 when the news came in about the inflation, and then a massive sell-off of almost 1%.
Do we have a graph or something?
Sure.
Before we get into this, what are we going to be discussing here? I know there are 5 macro elements we're going to be discussing during after hours, and we're going to be discussing them not only today but going forward. I want to create the expectation for people that that's the information you're going to be getting here. So what are we talking about here today?
Yeah, we've been dabbling around with macro themes in the past, but I really want to make that a core pillar here because every other things that we talk about on Traders Post Network is about individual trading, automated trading, and specific things day by day. But it's nice to have that larger context of what's going on for the week. And so the news I'm going to be bringing to you every week will be about equities, Bitcoin, the dollar, fiscal, and monetary policy. This will give you a nice recap of what's going on during the week so that you can set sail to fish the following week with a clear idea of what kind of weather is coming your way, right? This is sort of like, I want this to be like a weather report. This is still what we had over the previous week. This is what is coming up ahead, things to watch out for, things to notice. So for the NASDAQ today, so we've been having choppy sessions now for the last week. If you guys have been following price action live since the 26th, we do this Tuesday, Wednesday, Thursday, Friday. We've basically been had relatively sideways action, so it's been pretty much sideways all week. Then today, actually starting overnight, we peaked on yesterday's close, and since then it's been down. All right, it basically gave up all of the gains that were accumulated over the past week. Just wiped them out, all gone. And in this period of time, we had this little bump up over here. If you take a look at the beginning of today, at 8:30, we had a bump up to the volume-weighted average price, VWAP, for the daily, and then it completely gave up the ghost and fell down. Why does this matter? Because macro news is macro news, but what we care is how the market is digesting it. So when you see a sell-off like this, a massive sell-off following inflation news, you would think, hey, the market is expecting lower prices in the future, right? That's why markets sell off. Markets sell off because they're expecting lower prices in the future. Markets rise because they're expecting higher prices in the future. In general, we're not going to talk about passive investing and gamma and market makers and all that. In general, over time, markets move up because they expect higher prices in the future, and opposite for the downside. So if you had a sell-off now, it generally means that across equities, market participants think that this inflation news that's basically as expected probably means that the Fed has less reason to cut, right? You think maybe that's what's going on over here, because if inflation came in as expected at 2.9% core PCE, and we haven't increased, we're not getting a rise of inflation, so that usually means that the hikes are off the table. But Powell last week intimated that they would be cutting rates, right? Adding liquidity in. But if inflation is sort of like flat at 2.9%, that makes it like a little bit less likely that he can cut rates by 50 basis points, 25 basis points, whatever, come September. So it looks like that might be the case, except we didn't see this in the bond market. We didn't see the bond market like take a nosedive. If I pull up the bond charts here, the bond market continued its downward trend like it's been doing. It's been going downwards like it's been doing, expecting for these rate cuts to be coming on the short end. That's why you're seeing the short end of the curve down here. These are the lower ones, and then the higher end is up here. And so we have this this expectation that the Fed is going to cut. So it's like, if we expected that the sell-off is happening because people think that the Fed will not raise, not cut, but stay stable, then you would expect bond yields to also react pretty dramatically and maybe go up and bond prices go down. Didn't get that either. On top of that, the VIX moved up, but like barely, like went from 14 to 15. Nothing to write home about. So it's like, what is going on? What is happening here? Why are we getting such a sell-off? And is this a beginning of a larger trend, or is it just a small corrective move that we're having within equities? That's the big question.
So you say, like, I've heard you say this, I've heard Mike say this, I've heard other people say this. Is this the beginning of a larger trend? That sounds like trader psychopath speak for the sky. Is the sky falling? Am I right or am I wrong about that?
Well, not the sky falling. Is there an expectation for prices to be lower in the future than they are now? That's essentially what it is.
Prices to be
Right?
lower.
And yeah, is there an incentive for
prices of my
to be lower?
goods in the grocery store, prices of
No.
stocks on the market,
Peter,
prices of Bitcoin.
Goods in the grocery store, market prices, money-making prices. I can
Well,
make money on bananas.
Okay, but if the prices go down, that's bad. That's bad, right? Or is that not bad?
Wait, you talk about prices in the everyday for the regular Joe Blow in the economy?
No, when you say prices, we're expecting lower prices in the future.
Well, markets, a bullish move and a bearish move in the markets are not the same. Markets going up and markets going down are not the same. Markets tend to drift up.
Right.
And so if they're going to go down, that means not only are they going down because they're going down, but it's against the current that's trying to push them up. There's way more happening to push a market down than is to for it to go up. Naturally, because of passive investing and market participation, our markets generally drift up because, we have a system that transfers money from those who don't have to those who do, and there's a debasement of the currency, and so asset prices will go up, larger performers will go up, and so the market drifts up because of our different forces.
So when you say this, when you say we're expecting prices to be higher in the future, that's like me saying I'm expecting my BMI to be higher in the future, right? It's on that level, right? Like
it's more like I'm expecting the sun to come up tomorrow, and if the sun doesn't come up tomorrow, then I got to be like, whoa, what's happening here? What's going on? So a bullish trend, it's very comfortable. It's a day at the beach. But when there's a turn towards a bearish trend in markets, you can only get a long-term bearish trend in markets if things are seriously bad. And if this is the beginning of the trend, you want to know about it.
Okay, so I'm right. What you're saying in this, I call it the psychopath speech of a trader, is things are really bad and I guess getting worse.
Potentially. All right. So let's just go over some of the numbers here because I'm glad you brought that up. Let's just put this in context. Right. So we had a revision for the employment numbers for 2024. Every month they say this is the number of jobs that were created and destroyed, jobs added to the economy. A healthy economy has jobs that are continuously added. This is what you would expect. And yeah, there's revisions to these numbers. They do an estimate, and then they continue to do verifications, and then they find out, hey, we should have increased the numbers or decreased the numbers, and they let you know. These revisions come out every month, every quarter, every year. So we had a revision for 2024. Would you care to venture what is the delta that we have for the number of jobs that were created? So they tell us a certain number of jobs were created. If I were to tell you they revised this number for 2024, would you say that number would be higher or lower?
They revised it to indicate that more jobs were lost or not created.
Right. And what would you guess that number is?
I mean, I know the number. It's terrible.
They revised the jobs down by 818,000 jobs.
What? I thought it was 250,000.
818,000 jobs.
What? How is that even possible? Right. This is after they fired the BLS, the Bureau of Labor Statistics person. Like, I don't get it.
Oh, I don't know if they fired them or not, but I'm sure that also led. Well, who knows? You can imagine
818,000
jobs.
That's how much they were off.
Correct.
So, I mean, too slow, too late. Jerome Powell is, I mean,
the next day at Jackson Hole is when he announced they're going to be cutting rates because of problems to the job market.
Are they going to cut it by 75? I mean,
I know.
What?
I know.
And then all this is happening on top of what's happening in the UK and France? Rumors of IMF bailouts?
Yeah, but that's not...
it's not connected?
Well, the issues that are happening abroad have to do with the availability of credit, bond yields, this debt crisis that's happening. but let's just worry about our own backyard first.
Tom, I did not expect you to say that high of a number. 818,000? I mean, how is that even possible?
Okay, so that's why this whole thing of at Jackson Hole, when Powell talked about there was two issues. One, that inflation would have been higher because of the tariffs and the supply chain shocks, but they're not because growth is dying. Jobs are dying.
So people don't...
Which makes you wonder, how could you have 818,000 revision jobs less last year, downward pressure on the jobs market, so much so that the Powell wants to cut interest rates, but GDP is at 3.3%.
AI?
What's happening here? What's going on? All right. So
wait, hang on. Before you go any further, are we talking right now about equities?
Well, we're talking about equities in the context of the price move that we saw, and how is the market pricing this in?
All right, cool. So I just want to be clear, because we're going to be talking about equities, dollar, Bitcoin, fiscal and monetary policy, and I want to make sure that we're in the right segment. So what segment are we in right now?
Yeah, well, here we just crossed over into fiscal and monetary policy, but
okay, let me pull you back then, because I'm sorry, my overreaction to what you said. It's not overreaction. My reaction to what you said kind of sent us down that line. So I want to stick you on point with what you wanted to talk about.
All right, so let's go back then to. So we talked about equities here. Let's just go ahead and touch on the dollar. We're talking about strange things that are happening here. This is like what we're seeing in markets right now is sort of like if you hear they tell you that a meteor is coming towards Earth, but it's slowing.
I think they are saying that.
we have a way bigger problem than a meteor coming to the Earth. This is turning into something serious.
War of the Worlds. We need Tom Cruise now.
We're no longer let's evacuate the planet and go relocate on Mars and terraform. It's like, let's get the guns out and laser beams and let's see what's going on here. All right. So now if we take a look at the dollar. So I like looking at the dollar. Why? Because the dollar lets us know some of the stress that is happening within the system. Really think of the dollar as a barometer for the world. All commerce right now, until China takes over the world with their digital yuan, all commerce right now is essentially tied to the dollar. And the demand for the dollar, so how high that dollar is versus other currencies, lets you know if there's a lot of stress within the system or a lot of ease within the system. Because every transaction involved in the dollar is two things: buying or selling of an asset, and also buying and selling of the currency. So if we take a look at the dollar right now, we've been seeing the dollar in this consolidation range essentially since the beginning of the month, so August 1st. Okay? And this dollar, we had this massive move from when Donald Trump became president down, literally January 2025 inauguration. I think this is the inauguration? No. January 2025, boom, dollar came down. Massive easing, Bitcoin rose, equities all-time highs, all the good stuff. Then we had a bounce from the dollar from here up to resistance here at 99, or I'm looking at the futures, but so 99 on the futures, and then a pullback. Right? So this run up was like pretty scary because we don't know if this is going to be a trend change for the dollar. As we're seeing on the chart right now, we have red, 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 which is good for financial markets, bad for regular people, good for financial markets in the short term. And then now we switch to a yellow area. So the question is this consolidation area going to break up into a bullish trend or down? If it breaks up into a bullish trend, bad. If it goes down, good. Well, we've been bouncing around in here. That's why we've been going sideways. Now, the dollar has fallen now for the last 4 days. Exactly the amount of time that equities have been sideways. Equities just gave up the ghost. So you're like, what's going on? Dollar down. Equities good. And then at the exact same time, so that's for the dollar, showing that stress for access to the dollar has been easing, right? Because the dollar has not been going up. You'd imagine, oh, things should be okay. but then we're not seeing that in equities right away. And if you jump over to Bitcoin, we're definitely not seeing that in Bitcoin. Bitcoin is having the sell-off now. I think we're down 13%. Dollar down, Bitcoin up. Dollar down, Bitcoin up. Why Bitcoin down? Why dollar down, Bitcoin down, equities down? Well, when you have, and let's see what's happening with gold here. Yeah.
And what about
When
bonds?
Well, bond yields are coming down, which means people think this, they're banking on the Fed cutting rates, and there's a problem, so money's going to safety. So when you have equities down, Bitcoin down, so risk down, gold up, bonds up, then that means people are worried about the financial system.
Mm-hmm.
But in regards to equity prices, right? So they're worried about, hey, the consumer is worried, and the major investors are worried, because gold being, what is it? Gold is almost at all-time highs, while Bitcoin is falling. It means people want risk. They don't want the risk. They want the safety. All right. It's been a wild, topsy-turvy world, Peter, and I just want things to be right. I want Trump to come and make things better. Look, I am not the only one who's had a hard time with markets. My contemporary and equal Ken Carson, from high volatility, has been making was on a podcast a couple of days ago, yesterday, talking about how he sort of missed what's going on with markets right now. I love talking about not only Ken, but any type of FinTwit financial analysts out there. I love following them, because then you get a sense of, hey, what their opinion is, how they change. You get a sense of what's going on inside the economy, inside the financial system, especially if you respect what they have to say. And I've been quoting him again and again and again when he's right. It's only fair to quote when he's been wrong. So let's go ahead and take a quick look at a few minutes here of Ken Carson on the Adam Taggart Thoughtful Money show yesterday. Oh wait, you can't hear that, right?
Can't hear the audio.
All right, here we go.
Okay, so we have, regardless of where we might go over the next 10 to 25 years, we've got the world we have right now. We had this very volatile first half of the year, up, down, up big. I remember the last time I talked to you, Jam, you said that you thought that there was, because we were coming out of the doldrums, and you said that you thought the year would continue to be volatile, and maybe even we might still make new lows before the end of the year. Are you still expecting that type of volatility from here, given how the script has played out?
Yeah, so let's clean up exactly what we were saying and where we are. I think that's important. So one, expected that decline and called it, almost to the day in February. We thought it'd be about 15%. It went down as much as 22. We also prior said that 15% decline we thought was coming Feb to March would likely end up with a rally back towards the highs, or even maybe a minor new high.
So that's just to remind everyone, that is the drop that we had in equities he's talking about. He called for this this drop from February down here. Oh,
we don't see that.
Second. So he called for a drop from February, basically February 20th. I think he called it almost to the day, from over here down in April. This was the whole tariff war stuff that everyone was worried about. And then he also called that there would be a massive rally back, which is exactly what occurred, right? So we got this. This is what he's saying. They called that, and that's what they expected. But then he was also saying, hey, we can expect a rally up to maybe all-time highs and even more lows afterwards, which did not occur. So this is what he's addressing.
He said, look, come the summer or the fall, we would, based on what we knew or thought at the time, we would likely see a retracement from those levels, right? Because topping is a process that would be a bigger decline that could lead all the way till March or June of next year, which could be a much bigger decline that would go even below those lows. That was our view. Okay. We got kind of, and by the way, been fortunate enough to kind of get the turns quite right for several years now. The rally back has gone further than we thought. There's no question about that. We thought it would probably stop somewhere between 6,000 and 6,350 in the S&P. And here we are at 6,450, 6,500, right? Why and where do we think things are going now?
All right,
several.
Here we go. This is an important part, right? So he's like, the market went further than we thought, right? And so when someone's been right again and again and again, you got to take a look at what they're saying here, right? I remember having the same interest in Alex Gurevich, who talked about his thesis for the bond market and how basically Fed policy is offset by 2 years. And so basically you want to trade now, you want to invest now based on what the Fed said 2 years ago, not what they're saying now. And then he was wrong about bond yields last year or the year before that. And it was interesting following Alex Gurevich in that sense. Here, Kem is saying, hey, the market went higher than was before. So he's being self-aware and being like, okay, what's going on? Why did we get it so wrong? What are the different factors that we didn't consider or we didn't weigh correctly?
Things. One, I think we underestimated the amount of liquidity and how quickly the administration would provide that. The shortening of duration on the Treasury side has been dramatic. That's been silent QE, and liquidity has been fairly dramatic. Two, we thought, quite frankly, that the Federal Reserve would not come under the administration's umbrella, or their ability to influence policy would not come through till at least June of next year, if that. Given that, yes, they would take the chairmanship, but how do they get the rest of the governors on board? And in theory, you would, if you give a Nixon analogy, you would need some type of recession to stimulate or to justify just stimulating the way that we're talking about now. Was our thesis. Okay. Largely, that's not.
All right. So he's saying we did not expect the administration to provide liquidity as dramatically as they did.
So they did,
right?
They provided liquidity. I thought we were waiting for that.
Massive liquidity, right?
I don't understand. The market doesn't. The 50 basis points cut that people are expecting, isn't that?
No. That's not liquidity. The interest rate cuts affect markets 6 months to a year and a half out. All right.
Oh.
Cutting interest rates is not about, hey, those interest rates are cut right now. Now there's a bunch of liquidity. Cutting interest rates affects the ability for the short end of markets, so 3-month to 2-year bonds go down. And when they're down and the longer term yields are up, you have this funding mechanism that can happen when you lend long lend long, borrow short, depending on where you are on that equation. And so it's that differential. The wider that differential becomes, the more money that credit lenders can provide. And it's also no longer an incentive to hold money because you're getting less money on the short term. So you might be more inclined to put money into the markets. So there's that sort of mechanism, but it takes, like I said, 6 months to a year and a half for that to roll through the economy. Why it matters for people is that it's a dog whistle that says, oh, the Fed is putting a put in the markets. The Fed wants to make sure that markets don't go down. And so that's why the interest rate cuts are usually long for. It's an indication that, yes, the Fed is not just jawboning, they're putting their money where their mouth is. However, liquidity being provided into the markets can come in all kinds of different ways. It can come in different reserve requirements for banks, so that they don't have to keep as much reserves on hand versus the amount of loans that they output. The draining of the Treasury General account, the lowering of interest rates so that short-term bonds can be purchased in order to refinance the government. Dollar swaps, and all kinds of different machinations that happen behind the scenes in order to goose up markets. So liquidity has been being provided, so much so that we've been seeing equity markets rally, and even Bitcoin's been in a bull market since 2023.
I see.
Right, liquidity has been there. The dollar fell dramatically. I showed you that chart last second. So this is what he's saying, that the amount of liquidity that the administration was able to provide was like unbelievable. He just didn't anticipate that. And two, how quickly Donald Trump would get the Fed under his heel.
It feels like it's been forever.
No, it's 2025. Donald Trump was inaugurated mid-January.
Honestly, it feels like forever ago to me anyway. I know you're right.
Well, you got to think in terms of when you're dealing with policy and stuff like that, you're thinking 2 years before anything. Like if something got done in 2 years, you're like, wow,
right,
that's fast. The Fed will be like, we'll prepare your report and you'll hear about the report 5 years later. Like for it to happen in 6 months, this thing that never doesn't happen where the administration really gets good. They didn't replace the Fed chair and put a new one person in. They forced Powell to completely change his tune.
Force him. Look, he looked at the data. The data presented him the information, and he took the educated the choice that he had to make.
I heard Powell talk about Trump more than I've heard him talk about any other president beforehand.
Well, Trump is doing tariffs. A radical departure from the status quo.
He had to constantly reference it. He had to fight with it. No, I'm not going to be replaced. I'm not leaving. You know, the Leo DiCaprio meme. The problem. We even talked about the stuff with the Lisa Cook from the Fed governorship. Just the turmoil. Scott Bessent's out there selling bonds and like throwing Powell underneath the bus, trying to do forward guidance to say, hey, don't worry about what Powell's going to say. This is what's going to happen down in the future. I mean, Powell, when did you hear about Yellen or Bernanke or Greenspan being like put the screws to them in order for them to lower rates?
Well,
I don't know about that.
Did they have adversarial presidents that they were subservient to?
No, that's the whole point.
Mm-hmm.
That Donald Trump has been publicly adversarial, and you would imagine that the Fed, if they were going to do anything, it's not give in to politics.
Well,
and within 6 months,
into politics,
they gave in to politics.
Well, taking a stance to not give into politics is giving into politics. Not giving into politics is ignoring it and just following the data.
Okay. All right. And dogs can look up. All right. Look, Donald Trump became president in inaugurated in January.
Mm-hmm.
Late March, we started doing the whole tariffs thing. Right. And before the summer is even over, Powell's at Jackson Hole saying, hey, by the way, we're going to do whatever we can in order to help the administration. Not exactly, but that's basically what he said.
But you started off this whole segment here, the stream, saying that they might not do that cut.
Well, it doesn't matter if they cut or not. What we're saying so far is why Ken was saying that he was wrong.
I got it.
That liquidity was added to the markets and that the Fed was put under heel faster than he thought. He thought this would be next year. This would be happening. And that we would have a decline into that. All right, so let's finish off what he has to say over here.
That was not correct, right? I think that's pretty clear now. Just this week, I think we got, final kind of reality that not only has Trump now taken over at least 3, if not 4 of the 7 governor roles, which also, by the way, control the regional president's reappointment or replacement. So
just so you could understand how this matters to you, like taking over the roles, it's basically Trump has the 7 rings for the ring wraiths, and he's already distributed 4 of them.
Okay. All right.
Just to put it in context here.
Okay, good. All right. Thank you for the context.
Again, a full takeover of the Fed is now in process. But importantly, we also have gotten now at Jackson Hole a clear reversal of the Fed's inflationary mandate to control which by the way, we called for several years ago, but this is happening quicker than we thought, completely
Sooner than
abandoning
we
that
thought.
way sooner than we thought. We have also said for forever that the market is a weighing machine in the long run, but it is a voting machine in the short term. And if you want to call what I can tell you is what's going to happen with confidence in general in the next 10.
So that's good enough. It's very interesting. I could listen to Ken all day long. In fact, we'll listen to another clip in a second. But just to suffice to say, like, even for professionals whose job it is to just pay attention to markets all day, every day, what's been going on with the Trump administration is like beyond anything we've seen before, at least on a monetary policy and fiscal policy scale. This is unbelievable. Tariff wars, modifying the Fed, a public pressure, bond yield selling. I mean, the whole thing has just been crazy. And he's 6 months in, or 8 months in. Like, that's bananas. What is the next 3 years? Oh my God, it's going to be 3.5 years. What is that going to be like? All right. Before we get some more chem and talk more about markets, a little word from our sponsors.
Ask yourself this. Are you making trading harder than it needs to be? If you're trading manually or still coding just to connect to your broker, yeah, it's time to upgrade. Traders Post lets you automate trades using signals from tools like TradingView or TrendSpider or even your own custom setup. It works with brokers like TradeStation, Trade8, Coinbase, and a bunch more. I've been using it myself, and getting started was smooth. The platform's clean, setup's quick, and once it's running, it just works. And when you're ready to scale, adding more strategies, plugging into prop firm accounts, or juggling multiple portfolios, Traders Post handles it. It's built to grow with you. Start your free trial at traderspost.io. Trade smarter, automate your edge.
All right. Well, what's been bothering me is not the massive amount of liquidity that's been pumped into markets. That I'm happy about. It's what I've expected. It's what I wanted. But I wanted that to come with all-time highs in Bitcoin.
That's right.
And we haven't had any of that. Bitcoin has fallen pretty dramatically, 13% since the high, and it looks like it's going to continue falling still, right?
I see it.
If we take a look at Bitcoin here, oh, let me just share my chart. We take a look at Bitcoin, we can see here that the drop we're having is now below the high that we had here before in May 2025. So generally speaking, when you get a drop in, oh wait a minute. No, we're actually right at the highs. Generally, when we get a drop that goes to the high that we had before. Right, we often get a high that we had before, and oftentimes above that level. Here we have a drop, and we are flush. Basically, it's made Bitcoin basically go nowhere since the high of December 2024. So since before Papa Trump was president, Bitcoin basically did a round trip down to here. So it makes us wonder, okay, what's going to happen still? So if we take a look at my indicators over here that I like to pay attention to, these yearly moving averages, it's at these locations that we're expecting a bounce. And if that's the case, we can expect Bitcoin to go down all the way to 83, 82,000. And if that happens, that would be a 33% drop high, which is textbook.
You said wait a minute. Wait a second. Did you say 83?
I said 83.
But by when?
By peak to trough is usually, let's see here. Here it was, no, not from there, from here to here. So this was 111 days. This one was 145 days. So I guess between 111 and 145 days. So let's call it by October, which makes it that October is when I was expecting a peak to the cycle.
Yeah.
Which means the cycle might be peaked now. Yeah. There's a few things here you have to keep in mind. We haven't had the euphoric parabolic rise in crypto, right? Retail traders have not been the ones like driving this market. It's been liquidity dumped into the markets. So we know a couple of things to be true. One, you don't dump a massive amount of liquidity into the markets and just go, oh, well, I guess it didn't work. What you do is that you pull up the flooring, you start selling what you need to sell in order to put even more liquidity into the markets. And if there's anything I am confident in, is that fiscal and monetary policy, government and central banks can always find new ways of goosing that gander. So as long as Bitcoin hasn't fallen 50%, because Bitcoin fallen 50% is the sign of the top, which sucks. You have to wait for it to fall 50% to know. Sort of like, well, I wish I knew that 50% ago. Well, that's just what it is. Also, we haven't had rate cuts yet. We're having this topping behavior right now, but well, I want to play what Ken is going to say here in a second. But essentially, if we are going to head into this period where they're going to be goosing the markets, it's really only going to affect the big dogs, right? When liquidity gets flooded into the markets, it's not like a healthy thing. All right, it's heroin, right? And they're going to give the heroin to the people who need the heroin. They're going to super soldier up here. Let's go with that. We're going to super soldier up the people who need to be super soldiers. So we're going to get Captain America and Falcon and the Red Guardian and all that. We're just going to get a few of these things that are going to get the goose, and that will be the high performers. Right? The bigger you are, the too big to failure you are, the more you're going to get this liquidity. This is my thesis. And so for equities, Mag 7, yeah, Microsoft, right? Google, Nvidia, all the big dogs, I think you're going to be good with that. But Bitcoin is in there too. Right? Bitcoin has been spoken highly of by the administration, and they want that number to go up. And there's a very easy way for the government to make Bitcoin go up higher. 3 guesses what that is.
To make Bitcoin go up higher, they could announce that they're going to buy Bitcoin.
Or they just buy Bitcoin.
Or just buy Bitcoin.
They just go ahead and buy Bitcoin.
Mm-hmm.
How about they just go ahead and put a few $1 billion all the time constantly into Bitcoin and pump it up and tell everybody Bitcoin's going to be the new way, and look, the performance goes up and more people get in and we get the retail people there and we get the blow off top. Let's say they do that.
Mm-hmm.
Why would they ever do that? I don't know. They've done that for every other market
so far. Didn't Besant announce just a couple of weeks ago that they were stopping purchasing Bitcoin or something for the reserve?
Taco trade. Trump always chickens out. They're going to do whatever they need to do in order to make the number go up. Well, it's either that or we're at the beginning of a recession that's going to last the next 10, 15 years. So which horse do you want to back? Once we get to Bitcoin down 50%, then I'll have a different tune. Until then, up, and away.
So what do you think is going to happen?
No. We're not in the job of trying to figure out what we think is going to happen. That's not. There's no.
Okay.
Nothing good happens there.
What's the trade?
The trade is low leverage. You keep your day trading. So you're going to be day trading. This is fantastic because all we need is a trend. If the trend's going to be down, fine. If the trend's going to be up, fine. I just didn't expect the trend to be down, but day trading, everything works fine here. Don't quit your job. Things seem to be a little bit shaky. So as far as the trade in your personal life, keep your income streams. And when it comes to investing, you need to focus on the big players. Now is not the time, not financial advice, do your own research, not the time to start looking for the Pepes and the Shiba Inus to invest in. You stay with the big names like Bitcoin and Cardano. And the big names like Nvidia, Microsoft, Google, AI, all that stuff. Because chances are they're gonna get pumped up, and if they're not, well, then they're not. We'll figure that out as we go along.
I'm investing in Cracker Barrel. I think they're poised for a renaissance. I really love
Of course,
I love that they changed their logo and they changed their logo back. I'm very much looking forward to more of the flip flops. Going to trade that chop.
Well, Jaguar's been doing very well too. So hey, join on board.
Yeah.
So it's hard. It's hard to know what the trade is here because liquidity has been down, and now there is an expectation that liquidity has not been down. Liquidity has been up. That's the thing. If you take a look at the chart at the bottom right over here at the liquidity is rising. Liquidity is rising, and so the bias of liquidity up, markets always drift up. We're having down events right now. You'd imagine these are buy the dip opportunities. Do not underestimate buy the dip. Do not underestimate the empire. They want numbers to go up and to the right, and the only people who can stand in the way of that is God, and we never know what side he's on, and central banks, and we know what they decided to do. Right. Go ahead and support Papa Trump. So let's see what happens there. But for right now, that's your market minute. There, did we say it? Did we do it?
No, I don't know. I don't know if we did it. Okay, well, okay. So recap. Equities
down, and it might be the beginning of a trend down for the next few months. We have OPEX coming up, a major OPEX coming up in September, October. We'll talk about it more in September, but there's a reason why markets fall in September, October. It's a period of weakness. Volmageddon, you guys will remember that. Market down, Powell pivot, whole thing. Market crashes have often happened then. So for equities, September, late September, October could be a problem.
What's the trade?
Well, it depends how you want to treat it. If you're a long-term investor, these are buy the dip opportunities. If you're like, I want a 10-year thing, well, then look for these major drops, 10, 15, 20, 25, 30% down in markets in order to accumulate. If you're short-term and you still want to participate in the markets but be protected to the downside, puts or hedge. Get something that goes up when the market goes down, like gold and bonds. If you are risk averse, cash. Stay on the sidelines. No reason to be invested in the short term if that's what you're looking for. But volatility is the friend of the trader. And so I'm not saying these are things to avoid. They're just things to pay attention to.
The dollar.
Dollar is starting to fall lower. Now the dollar is going lower than I expected the dollar to go, which makes me wonder what's happening. The dollar is falling and gold's going up. So as long as the dollar stays above 96 or so, or doesn't fall too much to a new low, I'm sort of like, okay, this is sort of normal, sort of natural. If it really starts to break down and we start getting down below the monthly average or whatever, look to the skies for a meteor because things are going to be bad.
Bitcoin
in the middle of a 13% drawdown, totally normal. Bitcoin could go all the way down to 83 and still maintain the bullish trend, 82 even, and it still maintains the bullish trend. So buy the dips if you're a buy the dip kind of guy. If you are a microcellular and you believe that these are all volatility is a gift and every dip should be bought, go for it. Do I think Bitcoin continues to go up in the future? Of course I do.
And fiscal and monetary policy.
They're in the same boat. They're joined at the hip. Central banks and the Trump administration are joining forces together in order to make sure that your pocketbook sees the liquidity that it deserves. Whether that gets translated into higher prices and equity markets, well, we have yet to see.
Fantastic. Well, on this podcast, I always ask guests the exact same question at the end of the show, and that is, what is it that we should be talking about that we're not talking about? I'm kidding. I'm just copying it. Well, that's fantastic.
What was your favorite part of today's show, Peter? What was your favorite part of today?
That's Pete Holmes, right? You made it weird.
No, you're welcome.
You're welcome.
Michael Malice.
Oh, I see. What's your favorite part? Yeah. You made it weird is the God question and all that stuff. All right. Equities, dollar, Bitcoin, fiscal, monetary. You can find out about these topics every week on After Hours going forward. We want this to be a place for you to get your macro news. And Tom Hartman is the guy to give it. And I'm the guy to, I don't know, represent the everyman.
You're here to look cute. I'm here for a little bit of eye candy, a little sauce.
All right, Tom, you got anything on you've been trading? How did Powell go this morning? Price action line.
I was down $1,000. I made it. I made back 800. Mike was up 500 for the day. That guy, Mike, can dig himself out of a hole. The problem is he likes to have the holes to dig himself out of.
I think that's a problem that a lot of traders might have, and it's really good to be able to see you folks hash out your demons on stream. I do think streaming live is making you both accountable, and this prop firm thing is making trading a lot more fun. So I'm very excited to get into it myself. We had some interviews on the channel recently. In fact, one just went up recently. Definitely go and check that out. Price Action Live and Trading Bot Sessions. Those are streams and interviews that are on this channel. So like and subscribe so you can get the great content when we publish it online. Fun time, Tom. Time to go trade.
That's right. We'll be back next Friday at 4:30 Eastern Standard Time. But until then, as always, we wish you happy trading.